So in this series of videos, we're going to look at markets where a firm has market power. We're going to look at monopoly markets and something related called monopsony markets, which I'll explain later. So let's start by looking at a monopoly market. In the last lecture, I said that the marginal revenue was less than the price that they charge the next person when they lower the price to sell to another person. And I wanted to start by clarifying exactly why that is the case. So let me start by drawing three people who are going to be the potential consumers in the market. And let's call these three people Fred, Anna, and John. Okay, and I'm also going to assume that these three people have different valuations for the product in question. So each is willing to buy at most one unit, and Fred is willing to pay $10. Anna is willing to pay $8, and John is willing to pay $6. Any higher price than their willingness to pay, and that person will not buy. If the price is at their willingness to pay or lower, they are willing to buy. So let's think about it. If the firm were to lower the price from $11 to $10, what is the marginal revenue? Okay. Well, at $11, they're not selling to anyone. At $10, Fred is willing to buy. No one else is willing to buy, but Fred is. And so the marginal revenue would be $10. Okay. Now let's think about what the marginal revenue is if they want to produce one more unit. That is, rather than selling one unit to Fred, they now want to sell 2 units. We're going to assume that they don't actually know which of these consumers have higher or lower willingness to pay. They just know that one of the three values this product at $10, another one values at $8, and another values at $6. So they're not able to charge whoever has the highest valuation one price and charge another price to someone else. Rather, they have to set a market price such that they're able to sell whatever quantity at that price. Right? So if they produce another unit and they want to actually sell that unit, they're going to have to lower the price to $8. At that point, both Fred and Anna are willing to buy. So let's look at this. The revenue for Q is equal to 1 is $10. Okay, selling one unit to Fred. Okay. The revenue for selling a second unit, or selling 2 units in total, at $8 a piece is going to be $16. Write this a little bit clearer here. Okay, so what is the marginal revenue of that second unit? It is $6. They get $6 extra in revenue as a firm by producing one more unit and selling it. Why is the marginal revenue less than the $8 that they're charging to Anna? That is the price that they're charging for that second unit. Well, the reason is they had to lower the price to $8. So rather than earning $10 from Fred, now they're only earning $8 from Fred. So in order to sell more, they have to lower the price, so they lose money on the units they would have otherwise sold, selling that unit to Fred for $10. And so that's why the marginal revenue is less than the price that the next consumer pays. So let's erase that now. And I'm now going to solve an example monopoly problem. So suppose that you're the manager of a firm, you've had someone estimate the inverse demand curve, and you've also had someone estimate the cost function, sort of like we did in the previous lecture, or a couple lectures ago, where we found the cost as a function of the quantity of output. Okay, and suppose that the two respective equations are that the inverse demand is that the price that this firm is able to charge, assume it's a monopoly firm, is equal to 40 minus the quantity that they produce. Okay, so this is the inverse demand curve in the market. It's also the inverse demand curve faced by that firm. And we'll assume that the cost function is given by 4Q. So the total cost of producing Q units is equal to 4 times the Q units. Okay. So what do we do when we're solving this problem? We pretty much are always going to do the same thing. You set up some function that the agent is trying to maximize or minimize, and then you take the derivative, set it equal to 0. Or in some cases, you have multiple variables. It gets a little more complicated, or multiple variables with a constraint. It gets even a little more complicated. But the same general idea always applies. We set up the objective function, something that someone is trying to maximize or minimize, and then we use our math tools. So what is the thing that a monopolist is trying to maximize or minimize? Well, we assume they're trying to maximize their profits, or said another way, their revenues minus the costs. Okay, so they're going to try and choose a quantity that maximizes the profits, which are the price that they can sell that quantity at through the inverse demand curve, times the quantity that they produce, minus the cost of producing that quantity of output. Okay, and we can plug in for this problem, the price as a function of quantity is equal to 40 minus Q. Okay, we're going to multiply that by the quantity that they produce. So this first part here is price times quantity, and then we're going to subtract off the costs, which are 4 times Q. Okay, and so then to solve this problem, we're going to take the derivative of this function with respect to the one variable in it, Q, and set it equal to 0. So let's take the derivative of profits with respect to Q, and that's going to be equal to 40 minus 2Q minus 4 is equal to 0. Okay, or it's going to give us that 36 is equal to 2Q, or Q is equal to 18. So then we can go back and we can find the price. Remember, the price is simply equal to 40 minus Q, where Q is equal to 18, so that's equal to 22. And you can plug this back into the respective revenue functions, profit functions, and derive those values as well. Okay. Okay, so the next thing that I wanted to do is I wanted to derive a relationship that you've probably been told holds in an introductory economics class. You were probably told that the marginal revenue curve has the same intercept as the inverse demand curve, but has twice the slope. I'm going to show you where that comes from. We're going to use a similar set of tools, but rather than specifying an exact inverse demand curve, we're just going to assume a linear inverse demand curve with arbitrary constant, we'll call it alpha, and arbitrary slope beta. And so revenue is equal to price times quantity, okay, which with this functional form for price is equal to alpha plus beta times Q times the quantity produced. Okay, so how do we get the marginal revenue? Well, we're just going to take the derivative of the revenue function, treating these alphas and betas, which in any given problem will be a number, but for now we're just leaving them as arbitrary constants. We're going to treat them just like we would any other number. Okay, so let's take the derivative of revenue with respect to quantity, and that gives us alpha plus 2 beta times Q. Okay, so let's look at this. If we compare our calculated marginal revenue, or just the derivative of the revenue function, we can see that it has the same constant as the inverse demand curve. And in the inverse demand curve, the slope was beta. Here, the slope is 2 times beta. Okay, so it has twice the slope. So we've shown that it has the same constant and twice the slope as the inverse demand curve. You might be questioning why we have its alpha plus rather than alpha minus. It's really just a technicality. We could say minus beta. If we say minus beta, then beta would be a positive number. If we say plus beta, then beta itself is equal to a negative number. Okay, so here we have a plot of the equations I was just talking about. We have the inverse demand curve shown by this solid white line. It tells us that the market price is equal to alpha minus beta times the quantity that this monopolist firm produces. And we have a marginal revenue curve, which is supposed to have the same intercept and twice the slope. I don't know if it's drawn exactly like that, but that's the idea here. Okay. The marginal revenue of a given quantity is simply equal to the height of this marginal revenue curve at a given point. And the firm is going to keep producing up until the point where the marginal revenue is equal to marginal cost. So again, this dashed line is the marginal revenue curve. and they're going to charge or sell a quantity where marginal revenue is equal to marginal cost. The price that they charge will be the height of the inverse demand curve at that quantity. If the firm were not a monopoly and instead this was a depiction of a perfectly competitive market, we know that firms would set a price equal to marginal cost. So the quantity sold in a perfectly competitive market would be this quantity here. Okay. Now, if that quantity were sold at a price equal to marginal cost, the consumer surplus would be equal to the area of this entire triangle below the inverse demand curve and above marginal cost. So that would be the consumer surplus if price were set equal to marginal cost. But we know that firms set a higher price. They set the monopoly price. Okay? They set a quantity where marginal revenue is equal to marginal cost, and the price is the height of the inverse demand curve at that quantity. So they're charging a higher price. And their profits are equal to the price minus marginal cost, which is the height difference in these two lines, times the number of units sold, which is the horizontal distance of this point. And you can see that that's equal to this light blue area that's shaded on this graph. So that's monopolist profit. Of course, they're happier earning higher profits. But this actually has an impact on consumers. It has two impacts, in fact. You can see that those consumers who are still buying are earning less consumer surplus than they otherwise would because now they're paying a higher price. Additionally, there's this deadweight loss area that represents transactions which would be efficient but are not happening because even though the person values the product greater than marginal cost, implying that a transaction would be efficient, they don't value it as high as the price the monopolist is charging. Okay, so they're not going to buy. These missed efficient transactions are an efficiency loss, and it is one of the negative consequences of the monopoly market. So clearly, the sum of the consumer surplus and profits is lower in a monopoly market than it is in a perfectly competitive market. In a perfectly competitive market, the sum of the profits and consumer surplus is the entire area, including all three of these different shaded regions, below the inverse demand curve and above the marginal cost curve. Okay. Now, of course, the firm isn't earning any of these, but we're looking at the total surplus. We're considering, monopoly firm or the firm and consumers together, and looking at the total surplus. If we have a monopoly market, the monopolist is better off because they earn positive profits rather than zero profits. But the overall surplus in this market, if you add up consumer and producer surplus, is lower when you have a monopolist. Okay, so we don't necessarily like monopolies for that reason. At least economists are not thinking that's the optimal market structure, at least in a lot of cases. And so we want to prevent that for certain reasons. So if two firms try to merge just to gain a monopoly so they can charge higher prices, that is not allowed. We have antitrust laws we'll talk more about in class. Additionally, if firms don't actually merge but somehow agree to jointly charge the monopoly price and split the monopoly profits, that likewise runs afoul of antitrust rule. And this is not a new idea. I have this quote here from Adam Smith in his Wealth of Nations book. He noted, which is quite a long time ago, that people of the same trade seldom meet together, even for merriment and diversion. But when they do, the conversation ends in a conspiracy against the public, or in some instances, to raise prices. Okay, so this is not a new concept at all. Furthermore, in modern times, there is this concept called rent seeking, which makes matters even worse. Oftentimes, you'll have examples where a firm is lobbying the government or something like that in order to gain a monopoly. We went over one example of this earlier in one of our classes. We noted that medallion owners are trying to lobby government officials to restrict the number of medallions for taxi cabs in New York City so that each taxi medallion is worth more. Okay? Now, all that time and money spent lobbying politicians is wasteful itself. It's not creating something that is beneficial for society. It is merely effort used to try and give a firm or a group of people some sort of pricing power to raise prices. So you end up with this deadweight loss area and this wasted effort in trying to get that monopoly in the first place. So when you have rent seeking, I'd like to view that as doubly bad.